Hi, this is Phil Greenwood. We're going to look at the second section of our financing strategies. We'll call it the layering strategy part two, and look at the layers that are more higher risk, high reward types financing, and it goes beyond the typical debt grant type financing. If we look at our strategy, we want to, again, looking at layers of strategy. And the fourth layer we'd look at would be something I like to call them asset-based loans, things like GE Capital and other non-bank institutions like business development corporations will provide. These are going to be very similar to traditional banks, except they're going to be non-financial in the sense that they're not going to be FDIC insured. They're going to have a little more flexibility than banks do, but they're not going to have quite the capital safety and things of that nature. Usually they're going to provide collateral. They're going to look for collateralizable loans, current assets, long-term assets. Think of Dell Finance, Dell Computers, any of those companies that sell things to products and then turn around and have a financing arm. That would be under this section. And typically, you're going to be using what we call junior debt, or at least unsecured senior debt, meaning the lenders will be, in the case of bankruptcy, will be paid after the banks, and will usually, but will have to charge a higher interest rate in order to compensate for the higher risk. Once you've used up that layer, then you want to go to what we call a convertible debt strategy. This is actually becoming a really popular form of financing by angels, angel groups, and even some venture capitalists for very early stage financing. And all this really is your traditional debt financing. Usually won't have any security or collateral involved, but to compensate the investors for this level of financing, they're going to want a relatively high interest rate and the ability to hopefully convert at some point in time, to convert the debt into equity in the case if the common stock is worth a lot of money somewhere in the future. Fenwick and West, a big law firm on the West Coast in Silicon Valley, does a quarterly survey, and they just did a recent one on angels and specifically types of financing. And they're finding out that convertible debt and convertible notes are becoming very popular. Just a little bit of info from their survey gives you some background on convertible debt that's being used. Typically in the firms, and again, these are going to be West Coast firms, startups, early stage, software and such, so it is biased toward the West Coast, but I still think the terms that you'll see are very similar to here. In their survey, the median amount raised was $1 million. Investors who use this type of financing charged on average an interest rate of about 6%. Usually the terms of the debt would be convertible at the next financing round, and the financing needed would be a minimum of $2 million. So if after they got the note in the next round of financing, say venture capitalists came in, the investor who put in the convertible debt would be able to convert if there was at least a minimum of $2 million. And when they would convert, they would have what we call a valuation cap, meaning that of all the convertible debt financing, over 82% of them had this feature, where that when they convert, there's going to be a cap on the valuation of the company, usually around $6 or $7 million, so that when they convert, usually at a 20% discount or at 80% of, they would convert their $1 million into stock worth $800,000, so get a nice deal. Usually they would put a cap on the overall company value so that they wouldn't get diluted down too much. And in almost all cases, they used unsecured notes. Once convertible debt's used up, once asset-based lending and all other of the debt financing structures are used up, then you've got to go to preferred stock. And of course, this is the most common investment instrument of venture capitalists. And there's numerous types of preferred stock, but just remember that why they like preferred stock is that in the case of a company bankruptcy, they get rights to the liquidation or preference in liquidation before common shareholders, but after the debt shareholders. Probably one of the more common types of preferred stock that you'll see is participating convertible. meaning that usually it'll be a preferred stock at a dividend of say like 8%, with the ability to, like the convertible debt, to convert it into equity. But they have a participation feature so that possibly in the case of a liquidity event like an IPO or the company sold, they get the principal paid back times some multiple plus the ability to convert it over to common stock. Again, this is very popular with venture capitalists. You'll typically see a preferred round used in all venture capital financings, and you're starting to see more and more angel groups and bigger individual angel investors use this. Just remember, when you do the old preferred stock, it's a very complicated, just like any of the financing, but especially preferred stock. You're going to have lots and lots of terms and rights that the investor is going to try to negotiate. The valuation, control, any type of ratchet in the case of down rounds, pay-to-play features, meaning that the investor, you may be able to require the investor to invest in the next round of financing, or they lose their preferred rights. You're going to have some information rights, having to do audited financials and such, and there's always going to be a lot of discussion over how decision making is done. So preferred stock, not to say you want to avoid it if you can, but it can be a very long-term process. It takes a lot of time to negotiate and to develop the final deal structure. And again, once your preferred stock is used up, if you can't get any other type of financing, then you're going to try to go to the common share route. And most people know exactly what common shares are. In the case of liquidation, if the company goes under, if there's any money left over, the common shareholders get paid last. Of course, they have tremendous upside if the common share value goes up. You're still going to have your shareholder agreements. The biggest thing I instruct or advise to entrepreneurs about is always think of classes of common stock, like what Facebook and Google did. Could you have different, like a Class A or a Class B type of common stock that structure different voting rights? Sometimes that comes in handy, especially when you're seeking venture capital financing who are worried about the rights and privileges of the common shareholders. And shareholder agreements, of course, you spend a lot of time putting together when you start the company and in developing and